Rightio. 2024, kicking things off with a new podcast. The podcast idea that we've really come up with is something that we've been knocking about for a little bit, wanting to have a platform to have a general chat about the market. I think that there's a lot of good stories and information to share, amongst ourselves, but with our wider clients and the Newcastle market in general. So we thought we'd kick off the Newcastle Unlocked podcast and just really a casual way to really go through some of the information. We don't want to be too data heavy, which I know can get boring with commercial, but we'll try our best to make it as entertaining as possible. So really, we're starting off this year, and I think this new year is a little bit different to others. We've had a pretty wild few years with COVID and massive growth in the market and massive inflation, some uncertainty. And I think as we go into the new year, it's looking ahead, there's definitely optimism. I don't want to say there's uncertainty. Of course, markets are uncertain, but we've got some pretty interesting dynamics in the market. We've got a borrowing rate of around 6.5%, roughly. Cash rates in about 4.35%. You've got the feedback from the developer builders is that construction costs are starting to stabilise, which is interesting. We're also looking at CPIs around 5.6% for September and predicted to go to 4.3% at the end of this month in January. And the X factor is there's a possible rate cut at towards the end of this year. So that really, all of these dynamics playing around makes for a really, really interesting market for 2024. At the end of last year, look, there was still plenty of intent from buyers. And look, I'm probably more skewed to the commercial side of things, but there was plenty of intent from buyers. Obviously, 2023 was the year of price resets in commercial. I think that really with the borrowing rate the way it was, prices or price expectations lowered for buyers, and for vendors, they're just not willing to meet the market yet. But as time goes on, progress still needs to be made. So I'll be curious to see how the market plays around with these dynamics and works through it. But to try and figure it all out, and I'm promised that the two gentlemen with me today have got it all figured out. We've got two partners at Knight Frank here in Newcastle. We've got Dan Barry, Director Industrial, and we've got Matt Shaw, Head of Valuation. So thanks for joining us today, gents.
Thanks, Brent.
Thank you, Brent.
So, the conversation today is really off the back of our latest release of our House Views report, which is a report and our opinions based on data, but our opinions of where the market is for industrial and commercial. So, what are you seeing out there, guys?
Yeah, thanks, Brent. Look, and thanks for having us here today. I think the biggest thing on the industrial Q4 last year, there was some limited transactions, sort of above that 3 plus million space. It was, in my opinion, a bit of a rebuild phase for a lot of clients, developers, market research, building, and checking values. In some ways, there was more submission opportunities than probably in years past, and perhaps a little bit of indecision in the market.
Yeah, look, industrial is still very much the flavour of the month. It's not without its challenges, but yeah, look, at the end of last year, what I saw was, as I was saying before, a lot of intent from buyers, and there's a bit of a disconnect between vendors and buyers at the moment, which is all around the borrowing costs and some other factors. So there's definitely some positives going into this year. What about you, Matty? What are you seeing? You put all this data together. You've us agents have gone out and done the hard work, and you've grouped it all together. But you're the brains behind the operation. What's going on?
Crunching all the numbers. But thanks, Brent. The focus on our House View report's always generally been industrial commercial, because that's what we do. But as part of this latest document, I thought it'd be interesting to put some residential sort of statistics up there. It was interesting when I pulled the numbers. The residential median house price and unit value, particularly in the inner ring suburbs of Newcastle, has been strong. Double-digit growth for houses in Charlestown, and just under 10% for the Newcastle LGA in housing growth, and the same for unit growth. So that's encouraging. You talk to some of our clients, particularly doing sort of high-rise residential development in the CBD, and the unit sales off the plan is slower, but they're still getting them away. So that's an encouraging sign that that there's still some, I guess, buoyancy within the market there. And most of those buyers are still locals. A lot of them are downsizers that have selling, retirees that are selling and moving into town. So it's not it's not dominated by investors or anything like that. So that's a positive sign for the unit market. The other thing I saw as part of this research was that Cordell's construction cost index, which records the cost of a typical new dwelling, that cost escalation eased to sort of 0.8% in the 3 months to December. So that's now below the pre-COVID decade average of 1%. So what that's telling me is that you're not going to see construction costs go down, but I think that rate of growth or rate of cost escalation has certainly eased. It was, we were looking at sort of 4 and 5% a quarter there, 12 months ago, but now that's easing. So.
And that's been echoed through from what we're hearing from our clients too.
Yeah, absolutely. So look, the data's there, and the feedback from the clients is there, is that it's starting to stabilise, which hopefully makes it easier out there from a commercial property and a residential property point of view.
And obviously, it's all over the news: housing crisis, net migration back to Australia. It's all factorising. So it is curious to see those numbers because with the way that the borrowing costs are, it just really hasn't. I'm sure it's still patchy in places. It's not a. Well,
the other good stat that I found there was that in terms of housing approval, the Newcastle LJ is third in the state, and it's only behind. So that's 920 dwellings, only behind the Hills Shire in Sydney and Blacktown. So they're growth corridors, some of the biggest growth corridors in the country, and we're Newcastle's third in the state. So that's good.
Yeah, it is good.
It's a good sign.
So switching sort of to industrial, obviously it's still the golden-haired child of the market sectors, not without its challenges, but still pretty favourable from the market. What are you seeing out there? What are you thinking for the year ahead? And obviously, you've back into last year's fewer transactions, but still plenty of interest.
Yeah, sure. So, look, for those of you listening at home that are unsure as to why there's been an industrial boom for the last 4 to 5 years, there's been unprecedented growth because of an e-commerce boom. There's been a supply shortage, and there's also been a land crisis on the east coast of Australia. Like as a country, we're predominantly, all living on the eastern coast. We happen to be located on a major transport route. From Sydney to Brisbane, convenience to Melbourne, that sort of thing. So logistics works. We're obviously very mining focused here. Industrial in Newcastle has been quite resilient, despite some of the more capital markets reporting that things are easing and numbers are coming off and that sort of thing. So one question that is on the lips of everyone's radar is rental reversion. So we have had, some rental growth there, and design and constructs are needed with the rising construction costs and land costs. There is a need for rents to lift quite substantially. Typically we were always doing newer build leases around $135, $140 a metre. There's now requirements of around 200.
The other good thing about the industrial market that I see, like when you compare it to, say, Sydney or any of the capital city markets, is that, construction costs are pretty linear. Like they're probably not too different from Sydney, but our land values are still significantly below what they are in the capital cities, like by under half, you know what I mean? So
that's right.
That's still a positive sign for the Newcastle market, that, we're still an affordable location from an industrial point of view, even though, all the metrics have gone up significantly over the last few years.
And with you, when even your investors, the sharp yields that are being paid, there's got to be that if they're not getting the return on the front end, they're obviously looking at the rents going, these have just got to go up. Anything that's built, they've got to go up. You've just sold down at Moneybung, you've got a fairly good outcome for that as well, and that's just probably a case study for the
so 56 to 60 Moneybung Road, Cardiff, it was about a 3,000 square metre building. Had a passing rental of $115 a metre. So working off the numbers that I mentioned earlier, obviously there's a reversion potential there. So we ran a campaign, got really good interest. It sold on quite a tight yield, but the buyer looked at what he thought was rental reversion in years to come, and I agree with him. And I think there's a real good opportunity. I think he's bought it well.
And even just looking at success stories and Heather Bray's a project that you've been involved with, or our office been involved with for quite some years, and that's just that's covering all points really. You've had a project that, and you can tell the story better. What, 4 or 5 years ago, how much a metre?
Yeah, so 2015, a little bit longer. 2015 were $90 a metre.
Yep.
Now we're sort of surpassing 450.
I remember doing valuations out there for the client prior to us doing the agency there, and I was like, when are they ever going to be able to sell this industrial land?
I remember those conversations.
Remember those conversations? And that's going back about 8 years or so.
Yeah.
And yeah, it's just incredible how you've the first couple of lots away at 90, and now you've 5 times that number. It's it's incredible.
Yeah, and that's and the occupiers that are out there. You've got who's buying these lots. Is it people from Sydney? Is it locals? Who's buying them?
Yeah. So earlier on in the piece, we sort of put forward a bit of a strategy with the vendor to try and bring owner occupiers in. Mm-hmm. We wanted to sort of build a bit of a base that would ultimately now feed into what is an opportunity for developers to come in, build units, some higher yielding sort of stock that, can feed in and feed these owner-occupier businesses that have been there established for 5 to 7 years. Heather Bray's good at sand, so it's great for construction. Also good for sifting water away and that sort of thing, and flood events and stuff like that. We've got some exciting things going on there. Obviously, the M1 extension is
topical.
Is topical, and it's literally moments from the estate there. And in my opinion, it's not something that buyers have sort of cottoned on to as yet.
So it's really been standing on its own 2 feet, and when the M1 happens, it happens.
Yeah, well, I'm not sure how recent you guys have been out there, but the construction works, really has only sort of come on in the last 4 to 6 months. So now it's very clear where the road is going, and it is immediately next to the estate. So I think when we release our next stage in, say, 2 months' time, it's going to be something that's definitely going to be on the topic of buyers' lips.
Yeah, right. No, all good news. And, look, it's definitely still the golden-haired child at the moment, that sector. So there's some interesting times ahead. Commercial market is an interesting market at the moment. Obviously, we're facing some challenges in office leasing. There's a number of factors in that. There's a lot of new supply that's coming into the market. There's about 14,000 square metres in 2023. There's about 23,000 in the pipeline. We've had major disruption with COVID. I'm not telling people anything they don't already know with hybrid working, but that's still persisting into the market, and tenants are really just trying to work out what does the next 3, 5, 10 years look like. Whereas traditionally 10-year leases were commonplace, most of the requests for leases are 3 to 5 years. With all that new stock coming in, that means that there's a lot of space that's not fitted out. Fit-out costs have gone up substantially. So, and look, the economy's slow, so businesses are really questioning where they put their money. Do they invest $1 million in a fit-out? Can they do something a little bit more efficient? We've been through a similar process here with our office as well. We've had those same queries. We're growing our team, but at the same time, we don't want to go spend $1 million on a fit-out. So, it's understandable. And in time, that'll all be absorbed. But right now, it is challenging. Incentives are under tremendous pressure for new builds. But it's also, on the flip side, it's making renewals a little bit easier to negotiate. Now, of course, there's still incentives. They're not nearly at the level that new builds are. But there's values in fit-outs, anything with a quality fit-out, or even something that needs a little bit of work to it, but, they can stay where they are and re-rationalise it. I think that's obviously on the tenants' minds at the moment. So, it's a lot of space coming on isn't helping, but it will be absorbed, and there's plenty of opportunity out there, but we're just got to sort of ride through that at the moment.
Yeah. I think you're right there, Brent. Like the few sort of office valuations I did at the back end of last year, it was a lot easier to quantify or to put the capitalisation rate on the property was difficult because there's not a lot of sale transactions, right? But it is easier particularly if there's vacancy in the building, to work out what allowances you need to put in there in terms of incentives and letting up periods and all that sort of stuff, and market rents. And that's those, combined, particularly if you've got a building with a lot of vacancy, you put all those, 30% incentive in there, and a letting up period of, 12, 18 months, whatever that number is, it has a big impact on the value.
Absolutely.
So, Newcastle, the Newcastle office market, the CBD, is not really dominated, or there's not a lot of institutional owners there. It's still mainly privates, so there tends to be not too many sort of capital market transactions in a good times anyway. But certainly at the moment there's none.
No.
So trying to work out what sort of headline capitalisation rate you put on these valuations is hard.
It's a tricky work.
And I'm having to draw on other markets, other sort of metropolitan markets, not so much the Sydney CBD, but sort of outer Sydney markets, Penrith and Parramatta's and places like that, to sort of get an idea on what the cap rate should be.
And into that as well, we are a market with a lot of privates, and having the privates makes it a little bit easier to do some of these shorter leases. We're not having to behold to stockholders, to shareholders and stakeholders. They can really make decisions and make them quickly. So when we're doing renewals, or our experience anyway, is that we can renew for 3 years and, hopefully ride some of this disruption out. But anyway, still plenty of opportunity there beyond the office leasing. But, and look, obviously we've got our report. There's plenty of data in it. We'll put the link in the description so that our listeners can have a look at it. But I'm going to put you on the spot here. What's your predictions for 2024? What's going to happen?
My predictions for 2024, industrial leasing will pick up. There will be some marquee tenants signed in the area, maybe around that green energy space.
Yep.
I think logistics will continue to be strong. The ESG requirements of some of those users are pushing those rents up, as I mentioned earlier. So that's probably from a property perspective. From a macro perspective, I think we'll have interest rate cuts back end of this year. Which will, sort of alleviate some stress, perhaps assist the off-the-plan developer market, I think there'll be opportunities across the board.
Yeah, look, I think that there's obviously last year was the year of price correction, and a bit of a standoff between buyers and sellers in a lot of sectors. I think development sites this year, if anything that doesn't have income on it and they've been holding for maybe 12 months or longer, they've obviously, if they've held it for quite a few years, there's already inherent growth in it. But I think that anything that doesn't have income will be first on the chopping block, so to speak. But vendors are still, as I said, we're a market with a lot of private owners. I think vendors will still want to maintain price. So I think conditionality will start to come into it. Longer settlements, possibly subject to D8. So getting a little bit more creative with the purchasing structure, but to try and get that deal done at a closer headline price than they're expecting. And I do think there'll be plenty of buying opportunities, although they'll be patchy. So I think you've really got to look for them. But I haven't seen the pain acutely in the market from the interest rates. I think there's a lot of resilient private owners in our market who won't sell at any price, so we won't sell at a price below what they're expecting. And with the possibility of a rate cut at the end of next year, there's a bit of light at the end of the tunnel that the market might just happy to wait and see. So that being said, you still got to do business, you've still got to transact. There's different motivations, but I'll be curious to see how that runs.
Well, valuers tend to not like to make predictions and let the agents do that, but I'll have a crack anyway.
We'll hold you to it.
I concur with what you guys have said around the industrial and commercial markets. I think just from a residential point of view, I think there's still going to be, with migration into the country and still a housing shortage, that you're going to see, and the difficulty in actually buying a house with rates where they're at, I think you're going to see strong residential rental growth across both houses and units, and certainly within the inner ring suburbs, the CBD, and good locations. I think you'll see rental growth there for built stock, and the difficulty in getting new stock out of the ground will help that. So that's my sort of one prediction for this year, and sort of concur with what you guys have predicted as well.
Well, look, I think we'll leave it there. No one needs to listen to us for too much longer than this, but for what it's worth, jump on and have a look at our latest House Views report. We're going to be doing this regularly for a variety of topics, but I'd like to thank you both for coming on for the first episode, and we'll wrap it up there.
Thanks, Brent.
Thanks,
For
Brent.
having us.
Thank you.